No, I don't think decentralization is a problem for adoption. If I understand your question, properly. I think the organic growth of adoption has to do with understanding how it's different, and that spread of informational understanding is what's most important. And exactly what you're talking about. This is why, this is an important aspect, and this is what I was talking about on stage in Prague. One of the key points is that, look, institutions are coming. They're not quite here yet. I mean, we talk about it a lot, but they're not. You see the ETFs, it's not institutions yet. There's some, there are, hedge funds, some really big hedge funds that are using those, but they're also arbitraging them too, they're using them against futures and playing games with them.
Bitcoin is quietly cooking up a storm. And according to James Lavish, we are sitting on a ticking time bomb that could send its price soaring to levels most investors can't even imagine. Decentralization isn't holding Bitcoin back. It's fueling an organic explosion of understanding, showing the world how this digital asset is nothing like traditional stocks, bonds, or gold. As of August 19th, 2025, Bitcoin has already broken above $113,000, yet recent dips and volatility are just part of the game. Large holders are feeling the heat, short-term traders are panicking, but the bigger picture is far more electrifying. Adoption is steadily climbing, tech improvements are accelerating, and the groundwork for the next mega rally is being laid. Lavish explains that institutions are lurking on the sidelines. ETFs are mostly tools for hedge funds, not long-term investors, meaning the real institutional tsunami hasn't even hit yet. Once it does, Bitcoin's trajectory could flip from steady growth to pure vertical acceleration. What makes this time truly explosive is how adoption and price move on different paths. Wallets, lending, and integrations are quietly building a massive foundation that traditional metrics fail to capture. On top of that, governments are quietly inflating currencies to dodge hard defaults, creating the perfect storm for Bitcoin to shine as hard money. The ticking bomb isn't just hype, it's structural, systemic, and unstoppable. When adoption finally collides with institutional firepower, Bitcoin could rocket past expectations, leaving the $113,000 mark in the dust. The countdown has begun. As we bring you a short clip from James Lavish's interview, kindly take some time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. They would help boost the YouTube algorithm and support the channel's growth. Thank you. Please enjoy the video.
But our main focus is what we like to say, real companies with real revenues and real profits. Further down the timeline, they're more mature. You're able to look at the management, see what they've done, see where their vision is, get a good sense of where the market is. Because so many of these things, you're in Bitcoin, which is a completely new technology, completely new world, completely new market. How can you tell what the real market is for all of these companies? You can't just say the total addressable market is, $1 quadrillion. No, that's not really, that's not helpful. So we're just very careful now to weigh the risk reward against that Bitcoin treasury. If we're gonna make an investment in our portfolio, we feel it's got to have a better risk-adjusted return. That doesn't necessarily mean it will outpace Bitcoin, but it means that it will have a stronger return over the course of time, risk-adjusted. So it'll pull out some of that volatility, especially the downside volatility. So,
do you think that's valid? That as people start to add Bitcoin, that money goes away from tech startups?
Well, you got to unpack that. So let's unpack it in a few different ways. First of all, are they investing in just Bitcoin or in Bitcoin companies? So just straight Bitcoin, it should just be an allocation to portfolios, and it depends on what portfolio you're allocating it to. But a minimum of 2, 3, 4, 5% in my mind is necessary at this moment. As far as the early stage companies or venture capital companies and all that, whatever you're talking about, look, this industry has the same issue. It's not just the Silicon Valley startups. This has the same exact issue, maybe a higher failure rate, because it's such a new technology and everything's emerging and changing so rapidly. And I think that, one of our challenges and why we haven't done a ton of venture capital is because, we're trying to give returns to people that they'll be able to withdraw their money in 7 to 10 years, and have a great IRR over the course of that time. Now that means that we have to be careful about matching that timeline with the duration of a early stage investment. Most early stage investments, Sam, take a long time. And they do not pan out. First of all, most of them don't pan out. You have to have, a couple of excellent returns, in the we're talking about 50, 100x plus, or you've got to have a unicorn, 1,000 something, you've got to have some sort of Google or Facebook in there. Low probabilities. I mean, there's been a long trail of failed managers that just didn't allocate properly. Allocate meaning diversify properly, manage a portfolio properly, and we've seen this over my course of 30 years how this can happen, or levered themselves to certain situations and not realize that their whole portfolio is levered to that one situation. But anyway, so it's just hard to match that 7 to 10 year timeline with early stage investments in Bitcoin, which are, I can see them at 10, 15, 20 year timelines. And so that's a mismatch in the duration of the investment versus the invested capital, the timeline of the duration of the portfolio. It's a high hurdle, and it's typically you need to be further down the line for us. But that is a great question of how do you allocate there? Well, again, are you looking for exposure to Bitcoin companies that are early stage that could have that, 1,000x kind of return? Or are you looking for exposure to Bitcoin and Bitcoin companies and that ecosystem to grow with that ecosystem? See technology grow with that ecosystem rather than catch a couple of high flyers, right? Venture firms, they need the high flyers. They need some really good high flyers to unless they do something different than a typical venture capital firm and just put a bunch of money in Bitcoin, which is possible too, I suppose. The thing is, when you invest in a venture capital firm, you typically don't send all your money. I know some people who have done that. And I've actually got a friend who has got a fund at Yale who does that. But typically, you just have your capital calls. You identify investment, you do your research on the investment, due diligence, you negotiate out, then you do a capital call from your investors, and they send in a portion of money that would match that. So it's just a different philosophy for us. Our investing philosophy is just it's more of a let's manage risk around a portfolio, diversify it well, match the duration to the investor's timeline, and find situations where we can hopefully outpace Bitcoin on a risk adjusted basis. That's our goal. No, I don't think decentralization is a problem for adoption. If I understand your question, properly. I think the organic growth of adoption has to do with understanding how it's different, and that spread of information of understanding is what's most important. And exactly what you're talking about. This is why, this is an important aspect, and this is what I was talking about on stage in Prague. One of the key points is that, look, institutions are coming. They're not quite here yet. I mean, we talk about it a lot, but they're not. You see the ETFs, it's not institutions yet. There's some, there are, hedge funds, some really big hedge funds that are using those, but they're also arbitraging them too, they're using them against futures and playing games with them and leveraging them. And so there's just that's a completely different world and different game. But what we're talking about is, hey, when do the big money managers, the big endowments, the Harvards, the Yales, the University of Texas of the world, when do they come in? When does CalPERS come in? The California Pension Fund. When does Texas Teachers come in? The Texas Teachers Fund. These are behemoths. When they come in, then that filters to everybody. And it filters to everybody because, first of all, it'll get through the news and the news cycle will be, wow, not only do we have a bunch of companies that are using Bitcoin in their treasury. Now you have, you'll eventually have the big companies that are putting a portion of their treasury into Bitcoin, but now you have all of these institutions that are buying them. And when people hear institutions are buying them, they're thinking, oh, the institutions are, they're keeping it for themselves. But exactly what you said, they're not thinking, to that next level, which is, well, they're managing money for the people they owe money to, which are individuals who have worked for that company for a long time, or the endowments will use it to hopefully to create good good strong learning programs at those universities. But mostly it's retirement funds, pension funds, firefighter funds. Where look, you've got funds out in like Cleveland, Ohio, that are managing money and investing in Bitcoin because they have obligations to the firefighters' pension. They want to make sure that they meet them.
The central idea is that most investors prefer to place their money into established companies with proven revenues, steady profits, and management teams whose track records can be measured with some confidence. In these cases, the market potential is more predictable, and the risk-to-reward equation feels far clearer. By contrast, Bitcoin and its underlying technologies are still in the early stages of evolution. Because the ultimate size of the market is difficult to estimate, investors must weigh every decision against the unpredictable performance of Bitcoin itself. Startups built around Bitcoin carry especially high risk, often requiring long timelines before showing meaningful results, which doesn't always align with the 7 to 10-year horizons that traditional investors typically target. Venture capital thrives on the possibility of outsized wins, but the reality is that most startups fail before reaching scale. That's why the entry of large institutions, pension funds, endowments, and university treasuries into Bitcoin matters. They represent millions of people who depend on steady returns. For them, the objective is carefully managed growth that could, over time, even outperform Bitcoin while respecting both risk tolerance and long-term goals. Let's go back to the interview and watch more clips to gain insights from James Lavish.
It's really the individuals that end up ultimately owning them, and second, third derivative. So, and that expands the knowledge base tremendously. And that's really the big thing. It's not about, number go up and, people seeing the returns. It's more about, hey, can we understand this? And can we allocate to it from a bucket other than just risk assets? Because what the ultimate end game is here, Sam, is that money starts coming out of the bond portfolios and into Bitcoin. And that's the ultimate end game. And then it's just a completely different world. So you're going to continue seeing money coming out of tech stocks, money coming out of cash, money coming out of other cryptos when people get blown up there. Real estate, you'll have, young people who are like, well, first of all, I can't get credit for this game, this world yet. So I'm a young person. I'm 25, 27 years old, but I want to buy something that I've got this extra capital with that I can protect value in. And I don't really feel like buying gold, and tech stocks they're high flying. I want to do something different. And then you'll start putting money in Bitcoin rather than buying, a multifamily or townhouse unit where they're going to try to rent it out. No, you don't have cash flows. I hear that argument all the time, but you also don't have taxes on it. You don't have property taxes. You don't have maintenance costs. You don't have management costs, oversight costs. You don't have to worry about getting, people to rent from you, the renters. You don't have to worry about managing a landlord or management company. You just buy Bitcoin and hold it. Okay, so that goes all the way back to your adoption curve. One of the things I see a lot of here, Sam, is people use that S curve, right? And they overlay Bitcoin price with that S curve. I think that's a mistake. And that S curve is the adoption curve. And adoption doesn't really correlate very well with, of course it correlates to it, but doesn't correlate very well to price. Adoption could mean using it in different ways, every wallet isn't just an investor, it could be using for certain products, lending products, all that stuff. So there's going to be it doesn't correlate to price perfectly is what I'm saying. So, and of course, if you look at a log chart of any of these technologies that have been adopted, whether it's iPhones or it's Amazon, the price of that stock doesn't do this. It doesn't do that S curve. It's got that exponential curve, and so which correlates much more closely with something like a power law. And so that to me, where you have your bands of reasonable trading activity and price. And it makes sense from a lot of different ways, psychologically, market-wise. And then you see where it gets ahead of itself and it comes right back down. And so that is just a natural phenomenon that you can put any of those stocks in, the ownership of those. You can put Apple and Amazon and Google and all of those into that power law chart, and it would stay within those bands. So is Bitcoin perfect? It's pretty good, and it is expanding, and it's called What is Log Anyway, and it explains all this about adoption curves and pricing action around that. And I mean, it's really important to pull back, really pull out. Like right now, people are a little bit obsessed. Are we going to get through that all-time high? It's 120, 120. Like, where are we going to settle in? And we're back to 117. Oh no, the world's ending. No, the world's not ending. It's just, it's taking a breather. You have massive, massive whales who are taking some chips off the table. God bless them. They've held on to Bitcoin this long, and they became billionaires. Go buy your big house or land or whatever you want to do, and live your life. That's the whole point. The adoption curve is a little bit different than that price curve. But if you put it in log, you get a much better understanding of what's going on in the short term versus the life cycle of this emerging asset. Listen, people, we got to stop spending. We are on an unsustainable fiscal path. It is going so far up and to the right, meaning debt to GDP. The amount of debt it takes for each unit of productivity is going parabolic. We've got to stop. They're warning them about it. But Congress doesn't listen. They just keep spending. So that gets us to the third option, which is the option to default. You just default on your debt. You can reset it. You can start over. You saw what happened in Greece when they do that. It's awful. We've seen it in many emerging markets. You basically can't use your currency again as the basis for your own debt. You have to borrow in somebody else's currency. Nobody wants to have yours because it becomes hyperinflationary. So that's your third option. But you and I know that there's another option. That's a hard default, where you just stop paying interest on your debt. You stop paying back the debt, or you reset it at a lower, you give people pennies on the dollar of that debt, 40, 50, 60 cents instead of the 100 cents that they're supposed to get for each dollar. But instead, what we do is something called the soft default. And the soft default is expand the money supply, expand liquidity, keep generating dollars to make every single one of them worth less. And so you generate a higher amount of GDP, amount of productivity in dollar terms. No, it's not really real productivity. It's just more nominal, meaning just more dollars worth. So in the future, when $10 million is now worth $100 million, you can pay down past debt with cheaper dollars. And that's really the game that they've been playing, and they're going to continue to play, is let inflation run, let it be more than we admit to, and pay down that debt or keep it manageable.
James Lavish explained that Bitcoin is ultimately owned by individual investors, which significantly broadens the overall knowledge and understanding of the asset. He pointed out that the real goal is not just to watch prices rise or chase returns, but to understand Bitcoin as something different from typical risk assets. He argued that the major shift would happen when money starts moving out of bond portfolios and into Bitcoin, which could reshape the financial world. Many young investors, he noted, prefer Bitcoin over traditional assets like real estate or gold because it has no property taxes, maintenance, or management fees, just buying and holding, which is simpler. Lavish also talked about how people often confuse Bitcoin's adoption curve with its price curve. Adoption includes many uses such as wallets and lending, not just investing, so it doesn't always follow price perfectly. He compared Bitcoin's price evolution to tech companies like Apple and Amazon, showing it follows a power law growth pattern within natural market limits rather than a smooth S-curve. Regarding government debt, James Lavish described how instead of hard defaults, governments usually choose soft defaults by inflating the money supply. This means repaying debt over time with cheaper dollars, reducing the debt burden without outright failure. He explained that this inflation strategy affects the economy and Bitcoin's role, as ongoing inflation devalues currency but can help governments manage their debts. Lavish stressed that these dynamics make Bitcoin's market behavior and adoption complex, not just about short-term price moves, but longer-term shifts in finance and investment habits. With institutional interest still evolving, do you think the next big move will come from wider adoption or major market players stepping in? Please drop your thoughts in the comments below, share this video, and hit your thumbs on the like button. Thanks for watching. Don't forget to subscribe.